All right, let's dive right into this explainer. If you've glanced at the news lately, you've probably seen the headlines absolutely screaming disaster. The stock market is dropping, social media is in a total frenzy, and, a lot of people are asking if they should just sell everything before the bottom completely falls out. But hey, as focused learners, we don't just react to panic. We analyze the data. Today, we're going to unpack that sensationalism and neutrally examine the exact economic levers that are driving today's market volatility. We're treating these current events purely as economic variables so we can figure out exactly what's happening behind the scenes.
So before anyone panic sells their portfolio, we really need to ask the golden question here. Are we actually facing some unprecedented collapse, or is this just a predictable economic cycle? I mean, every market crash has a cause, right? This one is definitely not random. Our source material points to 3 specific macro triggers that are currently creating just immense uncertainty. And by understanding these triggers, we can figure out if this is actually the end of the line or just another cycle presenting a massive opportunity.
Here is our roadmap for today. First, unpacking the market panic. Second, tariffs and global trade. Third, geopolitics and national debt. Fourth, understanding market crash cycles. And fifth, the investor survival playbook. Let's get into it.
Section 1, unpacking the market panic, looking at media frenzy versus economic reality. Mainstream media loves a disaster because fear generates clicks. But we are going to look right past all that political noise and the finger pointing. Regardless of where you stand politically, our only concern today is how these macroeconomic shifts literally impact your bank account.
Section 2, tariffs and global trade. This is trigger 1, the economic ripple effect. Tariffs are essentially massive taxes slapped onto imported goods. On paper, it sounds like a solid strategy to protect domestic businesses by making foreign competition way more expensive. But in reality, they often carry huge, sometimes devastating economic side effects. To truly grasp what's happening right now, we have to look back at history. In 1930, the U.S. government passed the Smoot-Hawley Tariff Act, heavily taxing imported goods. At first glance, it seemed helpful for American manufacturing, but step 2 quickly followed, and that was foreign retaliation. Nations that used to trade with the U.S. fought back by raising their own tariffs. This made it incredibly hard for American businesses to sell overseas. Trade slowed to an absolute crawl, leading to massive business collapses. And finally, instead of fixing the economy, this massive tariff war literally helped turn a regular recession into the Great Depression. And this brilliantly illustrates the modern parallel we're seeing right now. Fast forward to today, and we're witnessing an escalating back and forth of tariffs. We have recent U.S. tariffs placed on Canadian energy and steel, ranging anywhere from 10 to 50%. In immediate retaliation, Canada imposed a 25% tariff on American imports, plus surcharges on electricity exports that affect major U.S. states. This isn't just political posturing, guys. It hits manufacturing hard and severely drives up the cost of base materials like steel. The absolutely crucial point here is how this all trickles down to you. When businesses are forced to pay more for materials, they don't just absorb those costs out of the goodness of their hearts. No, they pass them directly on to us, the consumers. That means higher prices on cars, appliances, and electronics. It also disrupts food supply chains, making everyday essentials way more expensive. And on a global scale, other countries aren't just sitting around waiting. Nations like China and Russia are leading the BRICS alliance, partnering with Brazil, India, and South Africa to actively form new trade routes that completely bypass American trade altogether. Moving right along to Section 3, geopolitics and national debt. This covers triggers 2 and 3. Looking at how geopolitics and massive macroeconomic debt strategies are severely spooking global investors. Trigger number 2 revolves around NATO and global defense. There are serious discussions right now about the U.S. stepping back from defending allied nations unless they up their financial contributions. Now, while that might sound like a fair business demand, markets absolutely despise uncertainty. If the U.S. pulls back from NATO, it creates a massive power vacuum. The second investors sense that global stability is at risk, they panic. This kind of unpredictability leads to fears of new conflicts, which instantly spikes military spending and causes energy prices to just skyrocket. It is a guaranteed recipe for a rattled stock market. Now, just look at this staggering number, $36.5 trillion. That is the U.S. national debt. And it brings us to trigger number 3, which is, frankly, the most fascinating theory presented in our source material. The theory suggests that the market might be taking a hit purposely as a strategic macroeconomic maneuver to deal with this exact figure. Okay, to really understand this theory, think of the national debt like a massive credit card bill. Imagine you owe $36,500 at a 10% interest rate. You're paying over $3,600 a year just in interest alone, making literally zero progress on the principal. Now, if the market crashes and a recession looms, the independent Federal Reserve is essentially forced to step in and slash interest rates to prevent a total economic meltdown. If those rates drop to, say, 3%, your interest payment plummets, saving you over $2,500 a year. So zoom out to a $36.5 trillion scale. If the government can force interest rates down, they can refinance the national debt and save trillions of dollars. It's an aggressive, high-stakes power move that relies on short-term market pain from massive long-term debt relief. Section 4. Understanding market crash cycles, from panic to predictability. So with those three triggers exposed, tariffs, geopolitical vacuums, and national debt strategies, let's pivot from the anxiety of all this uncertainty to the comforting context of historical facts. The reality is, market drops are not rare end-of-the-world disasters. They are categorizable, predictable events. First, we have corrections, which are drops of 10 to 20%. These are frequent and actually represent healthy market behavior. Next up are bear markets, dropping 20 to 40%. These happen every few years and last an average of about 289 days. Finally, we have full collapses, which are drops of more than 40%. While those are rare, the most vital piece of data here is that historically, every single one of these drops in the US market has been followed by a massive recovery. Every single one. And this brings us to the cycle of failure that traps so many everyday investors. When the market drops, fear kicks in, and people panic sell. All that does is permanently lock in your losses. Then, when the market inevitably recovers and stocks start rising again, greed takes over and people buy back in at heavily inflated prices. The biggest mistake you can possibly make right now is letting emotion dictate your actions. Section 5, the Investor Survival Playbook. 3 actionable steps. Now that we deeply understand the mechanics of what's happening and the history of market cycles, let's get right to the solution. Here is the high-level view of this playbook, derived from seasoned investors. Step 1, build a solid foundation. Step 2, think long-term. And Step 3, diversify your portfolio. These 3 highly structured steps are designed to transition you completely out of that state of emotional panic and into a state of disciplined, strategic wealth building. Let's break down Step 1. Before you even think about buying a single stock, you absolutely must establish a rock-solid financial foundation. That means you need an emergency fund covering 3 to 6 months of living expenses. It also means aggressively eliminating any debt with an interest rate higher than 8%. Once that foundation is secure, you need a complete mindset shift. You have to start treating the stock market as if it's on sale. Think about it. During the 2008 financial crisis, the investors who bought at the bottom saw their investments multiply within just a few years, while the ones who panicked completely missed the recovery. Moving to Step 2, thinking long-term. Here, dollar cost averaging is your absolute best friend. This simply means investing a fixed amount of money every single month, regardless of whether the market is up, down, or sideways. Because let's face it, no one can perfectly predict the exact bottom of a market crash. Dollar cost averaging completely removes the emotional stress of trying to time the market. It ensures you're steadily acquiring assets, and hey, when the market is down, your fixed amount simply buys more shares at a discount. Finally, we arrive at Step 3 and our ultimate defense, diversification. Spreading your capital across different asset classes acts like a critical shield during market turbulence. You really don't want all your eggs in one basket. A robust portfolio might include your standard stocks, but also dividend stocks, which are amazing because they generate passive cash flow even when stock prices are down. You mix that with bonds, precious metals like gold, real estate, and for some, maybe even a little cryptocurrency. That way, when one sector takes a hit, the others step up to help absorb the blow. So, as we wrap up this explainer, I want to leave you with one final, absolutely crucial question. Armed with the actual mechanics of the market, knowing exactly why tariffs and debt are triggering this volatility, and having a concrete understanding of historical market recoveries, what is your next move? Are you going to let sensational headlines force you to run for the exit and lock in your losses? Or will you use the strategies we just talked about to prepare, stay disciplined, and actually build generational wealth during this downturn? The choice and the opportunity is entirely yours.